Good morning, students. Welcome you all once again in the second and last class of Ind AS 16 Property, Plant and Equipment. So, students, in the last class, in the previous class, we have started this particular standard on Ind AS 16 Property, Plant and Equipment. And we have discussed what is meant by property, plant and equipment. And we have seen that property, plant and equipment are the tangible items which are held for use in the production or supply of goods and services, or held for administrative purposes or held for rental purposes, and which is expected to be used during more than one period. So if one, it should be a tangible item. The second, it should be held for use in the production or supply of goods and services, administrative purposes or rental purposes. The only exception was if the land and building was held for rental purposes, then it will come under the purview of Ind AS 40 investment property. It is not a PPE. And coming to the expected to be used during more than one period, technically means it should be expected to be used during more than 1 year, right? So then we have discussed when an item has to be recognized as a property, plant and equipment. And we have seen that there must be two conditions which needs to be satisfied for taking any item in the kitty of property, plant and equipment. So what was the two criteria which needs to be satisfied? First, there must be a future economic benefit. There must be a probability of future economic benefit out of that particular item, and cost should be measured reliably. So generally cost will always be measured reliably, or cost is identifiable if you are purchasing the property, plant and equipment. The second aspect is the future economic benefit should be probable out of that item. For example, if I'm purchasing a machinery, I'm purchasing a car, so of course the cost is known. But if the future economic benefit is not probable, in that case, that item should not be recognized, should not be capitalized as property, plant and equipment, right? Then we have talked about spare parts, standby equipment and servicing equipment. So spare parts, standby equipment and servicing equipment are these are the property, plant and equipment. These items are the property, plant and equipment if it is meeting the definition of PPE and it satisfies the recognition criteria. For example, there are some spare parts, standby equipment and servicing equipment, the life of which is, let's say, less than 1 year, right? So in that case, it is not meeting the PPE definition, and hence it has to be either shown as an inventory or it has to be written off. Yeah, right. It has to be written off in the P&L. So it has to be recognized as PPE if the recognition criteria is meeting. Otherwise, it has to be called as inventory, right? So we have then discussed about the initial cost as well as subsequent cost. So when first time you want to recognize an item as a PPE, so what was the criteria? Future economic benefit should be probable, cost can be measured reliable, right? Subsequent cost. For example, you have to, incur a major replacement cost, major overhauling cost, major inspection cost. If such kind of cost you are incurring, okay, I'm not talking about day-to-day cost. I'm not talking about, for example, you have purchased a car and you are just getting the the cleaning of the car on a regular basis, right? Or let's say servicing of the car on half yearly basis, or let's say quarterly basis. So I'm not talking about that. I'm talking about the major replacement. For example, you are replacing the engine of the car, right? So in that case, this major replacement has to be capitalized, provided the recognition criteria needs to be satisfied. And what is the recognition criteria? So the same recognition criteria applies to subsequent cost as well, which was there for the initial cost. And what was the criteria? Future economic benefits should be probable and cost can be measured reliably. Like in the example of turbine and machinery, in the example of car and engine. So we have seen that if this engine or turbine will not be replaced, this car or machinery will not be able to help in the production or supply of goods and services. Okay, so this will not be helpful, right? This will not be useful, right? So of course this future economic benefit is probable and cost is of course known, right? So we have discussed about the major replacement concept, okay, and we have done a case study, and also we have done one example on Excel. Then we have talked about major inspection. For example, in some industries, for some property, plant and equipment, as per the regulatory authorities, there is a requirement of major inspection, right? So it's not a small inspection. That inspection will carry a major cost. So there is requirement of some inspection, right? And as far as inspection is concerned, there would be major cost. So even though if the asset is fine, still after elapsing some period of time, or for example, in case of aviation industry, the rule is, for example, I'm not saying that this is the rule. I'm just taking a hypothetical example. And if the aviation authority says that this aircraft has to be inspected at after every 1 lakh flying hours. Okay. So if an aircraft will fly for 1 lakh hours, it has to be gone through the major inspection. Doesn't matter, it is airworthy. Doesn't matter, there is no any problem. Still, it has to go to the major inspection. So that has to be treated as a separate component, and major inspection cost has to be amortized, has to be depreciated over its useful life. For example, the life of the aircraft is 20 years, but the life of the inspection component is 5 years. In that case, the inspection component has to be depreciated over a period of 5 years. Other than inspection, the entire aircraft has to be depreciated over a period of 20 years. So friends, if you want to see this practically, I want you to please see the balance sheet of Indigo Airlines, right? Interglobe Enterprises, right? So friends, now the question arises, sir, when we have first time purchased this machinery, aircraft, or let's say car, so we are not aware about the cost of this component. Okay, and you are saying when you are incurring a major replacement or major inspection, you have to capitalize, right? So okay, we will capitalize that. But if I will capitalize the engine again in the car, so don't you think there will be cost of the two engine? Because when I purchased a car, it was inclusive of engine, right? So in that case, standard says that you have to decapitalize, you have to de-recognize the old engine, the existing engine, right? But sir, we are not aware about the cost of the old engine. I have purchased the car 6 years ago, and that car was complete car. And on the invoice, the cost of the engine was not mentioned. Okay, then standard says that if you cannot calculate, or if you cannot identify the cost of the existing part, existing component which has been replaced, in that case, use the current cost as a surrogated cost. Okay, so today you are replacing the engine, and today you are aware about the cost, right? For example, the cost is 5 lakh rupees. So standard says that use this cost as a surrogated cost. Discount it to the time when you have purchased this car. So you have purchased this car 6 years ago. So discount it back to the 6 years, right? So if today the value is 5 lakh, what was the value 6 years ago? Okay, so we have to calculate the present value before 6 years, and whatever present value will come, that will become the original cost of that particular component. For example, the entire cost of the car is 10 lakh rupees. The present value of 5 lakh is, let's say, 3 lakh rupees. So cost of existing engine is 3 lakh rupees, and the remaining portion is 7 lakh rupees, right? And for example, that life was 10 years and 6 years have gone. So we have to calculate the net book value according to this 3 lakh for 6 years. After 6 years, the net book value will come, and this net book value will be the loss on de-recognition of the existing component. Sir, if we have some money by scrap sale, then of course, then loss on de-recognition will go down, right? So friends, we have discussed all this concept of subsequent cost. Then we have discussed, okay, sir, we have understood that this is the property, plant and equipment, right? We have to recognize, because the recognition criteria is also meeting, and now we have to recognize this item as a property, plant and equipment. Now the question arises, sir, at what value should we recognize this property, plant and equipment? And friends, we have discussed that property, plant and equipment has to be recognized at cost, right? It has to be recognized at cost, right? So what is the component of the cost? Cost means purchase price, invoice price, including import duties. If you have purchased from foreign countries, you have paid some import duties, that has to be capitalized. And non-refundable taxes, you have paid GST and input credit is not available, that the GST has to be capitalized, right? If the input credit is available, GST is not required to be capitalized, right? After deducting discount and rebates, if you got some trade discount and rebate, that has to be deducted. Then directly attributable cost, sir, what is the directly attributable cost? I can say that incremental cost. Directly attributable cost means the cost which has been incurred just because I have purchased this asset. So directly attributable cost means the cost. This cost would not have been incurred if the asset would not have been purchased, first of all. Second, directly attributable costs are those costs which is necessary to bring the asset into the location and condition necessary as intended by the management for its use. The machinery was located in China. My factory is in India. So if the machinery was there in China, there is no use of that machinery according to me. So if the machinery will come to my Delhi factory, only then I can use the machinery. So for bringing the machine from China to Delhi factory into this location, whatever expense I'll incur on the transportation, carries inward, freight inward, so that has to be capitalized. For using this machinery, for bringing the machine in the condition, for making it usable, whatever I'll expense, for example, training cost. When I say training cost, mandatory training cost, trial run cost, for example, assembly, site preparation, installation cost. So these costs are required to be capitalized. And the third one is, if you have installed some property, plant and equipment, and it will also incur some cost in future, like asset retirement cost, site dismantling cost, site and asset dismantling cost. So these are the same cost, the names are different. So if you have some asset retirement obligation after 20 years, after 10 years, after 5 years, so you have to recognize the future, you have to recognize the present value of that future cost as a part of the cost of the asset, right? We have discussed this. We have discussed some example of directly attributable cost. And what is not directly attributable cost? For example, cost of conducting a business in new location or with a new class of customer. Cost incurred in introducing a new product or service, right? Cost of opening a new facility, like advertisement cost, cost of inviting Mr. Amitabh Bachchan for cutting a ribbon, right? Administrative and other general overhead costs, for example, audit fee expenses. So these costs are not the example of directly attributable costs, right? We have done some case study also. Then we have discussed some special cases. Sir, what happens if the property, plant and equipment has been purchased on a deferred payment credit terms? In that case, standard says that the cost has to be there. So the cost of the item of PPE should be the cash price equivalent at recognition date. The cash price equivalent at the recognition date. For example, I am purchasing my the machinery with my own funds, so it is worth rupees 1 lakh. Okay. And for example, Sai is purchasing the machinery from the loan funds, or let's say Sai is asking for credit, right? So the machine has costed 1,20,000 to Sai, right? So this 20,000 differential, so it will not reflect a true picture if I'll recognize that 1 lakh, Sai is recognized at 1,20,000. So stakeholders will say that, oh, this machinery, according to so basically Sai has spent more to 20,000 more on acquisition of fixed asset, which is not right, which is not a right thing, right? Which is not a right picture, because Sai has delayed in payment. That is why Sai is paying 20,000 extra. So it will not reflect a true picture, although myself and Sai has purchased the same machinery, same asset. So standard says that if the PPE has been purchased on a delayed payment terms, on a deferred payment terms, in that case, the cost of the PPE is cash price equivalent at the recognition date. Okay. Then, sir, what will be the difference between 1,20,000 minus 1 lakh? This 20,000 has to be recognized at finance cost, right? It has to be recognized in the P&L. If the asset is a qualifying asset, in that case, if Ind AS 23 permits you that you can capitalize such borrowing cost to the cost of the asset, in that case, that can be capitalized. Otherwise, PPE has to be recognized at the cash price equivalent, right? So we have done a case study also on this. So friends, we have done the deferred payment credit terms case study, and we have also discussed about the initial cost case study concepts, right? So now let's discuss important concept on exchange of assets, right? What is meant by exchange of assets? Before that, let me see if you have any query. Otherwise, I'll move on. Sai is asking, sir, as per income tax, we follow the gross block for asset. then WDV of existing value of component value we deduct from gross block before adding the new value. Sai, I'm not getting your query. So Sai, in income tax, we are not following gross block concept. So to my mind, in income tax, we are following WDV concept, right? So whatever WDV of the net block is there, so you have to follow that concept. I don't think you have to follow gross block concept in income tax, right? Yeah. So guys, exchange of assets. So what is meant by exchange of assets? So coming to the exchange of assets, for example, so far we have only discussed the example where you are purchasing your fixed asset by paying a cash, right? So now we are talking about exchange of assets. When I say exchange of assets, it is like a barter transaction, right? It is like a barter transaction. So exchange of asset. An asset can be exchanged. A PPE is acquired in exchange of non-monetary asset, or a combination of monetary and non-monetary asset, right? Monetary and non-monetary asset. For example, a building is purchased in exchange of Mercedes car and 20 lakh of cash. This is an example of combination of monetary and non-monetary asset, right? Monetary and non-monetary asset, right? So I'm also paying a cash, and also I'm giving my Mercedes car, right? The second example could be a building is purchased in exchange of an aircraft, right? So this is an example of non-monetary asset exchange, right? Monetary asset exchange, right? So friends, exchange of assets means when an entity is acquiring a fixed asset, yeah. When an entity is acquiring a fixed asset, an entity is paying some non-monetary asset. For example, an entity is giving a software, an entity is so an entity is exchanging the property, plant and equipment, purchasing a property, plant and equipment in return of giving some non-monetary asset like investment property, intangible assets, or let's say other form of tangible assets. For example, car, aircraft, okay, or a building has been purchased for a plot of land, right? So it is like a barter transaction. So if it would have been the cash transaction, the life was pretty simple, and we have seen that, right? But if it is a barter transaction, an item has been purchased for another item. In that case, at what value the incoming item has to be recognized as a PPE? At what value? What should be the measurement, right? So friends, the standard says that first of all, you need to see that if the transaction is having a commercial substance, right? The transaction is having a commercial substance, and this word you have gone through with this word in multiple standard, and while teaching you guys in days 115 revenue from contract with customer, I have also discussed the meaning of commercial substance, okay? And if you remember, I have discussed one example. A Louis Philippe outlet is purchasing a shirt from another Louis Philippe outlet, okay? So they are exchanging with each other, right? So in that case, revenue should not be recognized. Why? Because there is no commercial substance, right? What is meant by commercial substance? So commercial, that transaction should make a sense, right? For example, I am buying a, let's say I am buying a Hyundai Verna car. I am buying a blue color Hyundai Verna car in exchange for white color Hyundai Verna car, right? So technically speaking, I am exchanging one car with the another car, right? I'm just changing the color, right? So this transaction does not have a commercial substance, right? This transaction does not have a commercial substance. The nature, the purpose, the usage of this asset is same, right? So if the transaction does not have a commercial substance, in that case, it has to be recognized at cost, right? So just think about it. If the transaction does not have commercial substance, then you have to recognize that item at a cost, right? At a cost, I mean to say WDV of the asset given up. For example, I am buying one car in exchange of another car. For example, blue color Hyundai Verna car in exchange of white color Hyundai Verna car. So my blue color Hyundai Verna car was having a WDV of 1 lakh rupees, right? And I'm buying white color Hyundai Verna car. So I have to record white color Hyundai Verna car at a WDV of the asset given up, so which is 1 lakh rupees. So in my books of accounts, there will not be any change in the numbers, right? This 1 lakh has to be 1 lakh, right? I cannot plan anything. But if the transaction is having a commercial substance, if the transaction does not have commercial substance, first of all, does not have commercial substance, in that case, asset acquired has to be recorded at the WDV of the asset given up, right? At the WDV of the asset given up. Clear? I hope it is clear to all of you, right? Okay. But if the transaction has commercial substance, then what will happen? And I request each one of you that please write down. If the transaction has commercial substance, right, then in this case, what we are required to do, if the transaction has commercial substance, then asset has to be recorded at fair value. Then asset has to be recorded at fair value. Okay. Asset has to be recorded at fair value. Okay. And fair value has to be taken as per below hierarchy. Please write down as per below hierarchy. I would request you guys to please write down, because this hierarchy you will not find in your study material. Okay. So what is the hierarchy? Number one, the first one is fair value of asset given up. Okay, so fair value of asset given up, right? For example, the first hierarchy is fair value of asset given up, right? Or you can say that, for example, fair value of asset given up oblique fair value of asset acquired. So whichever fair value is identifiable, right? So fair value of asset given up or fair value of asset acquired, whichever fair value is identifiable, right? Sir, for example, the fair value of asset given up is not there, but fair value of asset acquired is there. Then of course, fair value of asset acquired is the value of the PPE which has to be recognized in the books of accounts. Sir, for example, fair value of asset given up is there, but fair value of asset acquired is not there. Then, of course, in that case, you have to go with the fair value of asset given up. So first of all, there are two fair values. So whichever fair values is clearly identifiable, that fair value will be the cost of the asset acquired, right? Second, if fair value of asset given up and fair value of asset acquired, both are identifiable, right? Both fair values are there. Then record at fair value of asset given up. Asset given up. Right. Recorded fair value of asset given up. Clear? So, sir, if both the fair value is given, then I have to recognize that fair value of asset. Then I have to recognize that fair value of the asset given up. Right. Sir, if one of the fair value is given, then you have to go with the that fair value. Okay. Third, if both the fair value are not clearly identifiable, if fair value are not known, then WDV, because WDV of the asset given up, this WDV you are always known because you have already recognized the asset in your books of accounts. Then whatever WDV of the asset is there, WDV of the asset given up, okay, because you are giving the asset, you are de-recognizing the asset. So whatever WDV is there, so that will be the value of the asset acquired. Okay, I hope it is clear to you guys, right? I hope it is clear to you guys. Clear? Fair value of asset given up or fair value of asset acquired. If either of the fair value is there, so whichever fair value is clearly identifiable, that will be the value of the PPE, right? Okay. So if fair value of asset given up and fair value of asset acquired both are identifiable, then record at fair value of the asset given up, right? Then record at the fair value of the asset given up. Okay. So if both the fair value are not clearly identifiable, then you have to record at the WDV of the asset given up, because this WDV will always be identifiable. Clear? So the first priority is fair value of the asset given up, because this is the consideration which you are paying, right? So fair value of the asset given up is the first priority. Clear? I hope it is clear to everyone. Trinidhi is asking, sir, for example, PP is purchased in exchange of issue of ESOP, in exchange of issue of shares. In that case, the PPE has to be recognized at the fair value of the asset given up. The second preference will be the fair value of the asset acquired, the fair value of the shares, right? The fair value of the shares. Clear? So PP is purchased in exchange of issue of shares. Sorry, I have just told you reverse. So if I am issuing shares, so whatever I am paying, I am giving you shares. My consideration, I am paying you consideration in the form of the shares. So PPE has to be recognized on the fair value of the shares given up, right? If the fair value of the shares given up is not clearly identifiable, then PPE has to be recognized at the fair value of the PP acquired, right? Clear? I hope it is clear to everyone, guys. Let me again come back to my PPT. So guys, if PP is acquired in exchange for other non-monetary asset or for a combination of monetary and non-monetary asset, major cost at fair value, okay? Unless the exchange transaction has no commercial substance, and fair value of neither the asset received nor given up can be measured reliably. So in barter transaction, in exchange transaction, PP has to be recognized at cost only in two conditions. One, there should not be any commercial substance of the transaction. Second, the fair value of either asset given up or asset acquired is not identifiable. So in only these two cases, asset has to be recorded at the WDV of the asset given up, right? At the cost. Otherwise, asset has to be recorded at fair value. I hope it is clear to everyone, guys. Yeah, Srinidhi, Sai, Utkarsh, Megha. Great. Yes, Megha, you are right. So the first priority is fair value of the asset given up. If it is not there, then the second priority would be fair value of the asset acquired. If that is not there, then the third priority will be, of course, WDV of the asset given. Right. So let's do this case study. Pluto Limited owns land and building which are carried in the balance sheet at an aggregate carrying amount of rupees 10 million. Right. So Pluto Limited owns land and building. So this is already their existing asset. And the carrying amount, the WDV of land and building, the land and building WDV in the books of Pluto is 10 million, 1 crore, which is 10 million. The fair value of the such asset is 15 million. The fair value of the asset given up, fair value of such land and building, fair value of land and building is given up at 15 million, 1.5 crores. It exchanges the land and building for a private jet. Okay, it exchanges the land and building for a private jet. Okay, and what is the asset acquired? Asset acquired is private jet. Okay, and the fair value of this private jet, fair value of asset acquired, fair value of acquired asset is 20 million, 2 crores, and pays additional 3 million in cash. Okay, so basically Pluto Limited is surrendering, is giving land and building first, and Pluto Limited is also paying 3 million of cash, right, in acquisition of a private jet, right? So what is the fair value of the asset given up? The fair value of the asset given up is 15 million. What is the fair value of asset acquired? It is 20 million. Okay, and the Pluto Limited is also paying 3 million extra, right? So guys, this is a cash. So this is a case of combination of monetary and non-monetary asset. Tell me at what value this private jet has to be recognized. Tell me at what value this private jet has to be recognized. Srinidhi, Sai, Megha, Utkars, Varun, at what value this private jet has to be recognized? First of all, here fair value of asset given up and fair value of asset acquired, both are there. So which fair value we needs to be taken? Which we need to take? Which fair value we need to take? Yes, Megha, you're right. So we need to take the fair value of asset given up. That is the first priority. And what is the fair value of the asset given up? It is 15 million. Okay. So 15 million plus you are also paying a cash. Okay. 15 plus 3, 18 million. So 18 million is the value of the private jet, right? So provided that the transaction is commercial substance, the entity should recognize the private jet at a cost of 18 million and should recognize a profit on disposal of the land and building of 5 million, calculated as follows, right? So fair value of asset acquired is 18 million, 15 plus 3, and the carrying amount of building was 10 million. Okay, and the cash which it has paid is 3 million. So what is the profit? Profit is 5 million. And how to calculate this profit? First of all, the private jet has to be recognized at 18 million. It is clear. So private jet, PPE, private jet account debit, right? So private jet account debit, which is PPE, 18 million, right? To land and building. Of course, I'll credit land and building at WDV, 10 million. To cash, 3 million. What is the difference? To profit on exchange, 5. So this is the solution. I hope the solution is clear to everyone. Yeah. Sairam, it is not 23 million, it should be 18 million. 15 million is the fair value of the asset given up, plus you're also paying a cash of rupees 3 million, right? So the total fair value is 15 plus 3. You are paying a land and building, you are giving a land and building, and you are paying a cash also. So 15 plus 3, 18 million, right? So 18 million is the cost of the private jet which we have acquired, right? I hope it is clear to everyone. Yeah. Shall I move forward? If it is clear to everyone, shall I move forward? Yeah. Okay. So guys, we have covered the special cases of, let's say, deferred payment, credit, and exchange of assets. Now let's move to measurement subsequent to initial recognition. So far, we have only talked about the initial recognition, right? And we have discussed subsequent cost also. Now, for example, if you have recognized an asset during the year, then what will happen on subsequent to initial recognition? I mean to say at the reporting date, what you will do. For example, if you have purchased a car today on, let's say, 15th March 22. So what you will do on 31st March? So on 31st March, when you close the balance sheet, of course you will depreciate that car. You will charge a depreciation of 16 days. Am I right? So you have to take the car in the balance sheet at carrying value, at the WDV or at carrying value, right? You have to check the impairment testing as well. You have to do the impairment testing. If there are impairment indicator, you have to do the impairment as well. So the standard talks about once you have initially recognized the property, plant and equipment, what will happen subsequent to initial recognition, right? What will happen at the reporting date? So standard says that at the reporting date, the company can choose either cost model or revaluation model as its accounting policy. So the company can carry the property, plant and equipment in the balance sheet as per cost model, or the company can revalue the property, plant and equipment and carry the property, plant and equipment in the balance sheet on the revaluation model, right? So there are two models, and these are not the new models. We have also learned these models. We have understood these models in accounting standard 10 as well, right? So company has two policy, cost model and revaluation model as its accounting policy, right? Now, sir, what is meant by cost model and what is meant by revaluation model? So let me make you guys understand with the help of this Excel file. So we are talking about measurement subsequent to initial recognition, right? We are talking about, for example, if we have purchased the car today, we are talking about what happens on 31st March, right? So measurement subsequent to initial recognition. So there are two policy, okay? There are two policy choice. So as far as measurement subsequent to initial recognition is concerned, there are two policy choice. One is cost model, and the second one is revaluation model, right? Revaluation model. So as far as cost model is concerned, cost model means the PPE is carried at original cost, right? And what is the formula for calculating the carrying amount? What is meant by carrying amount? Amount at which the asset is carried in the balance sheet. So what is the formula for carrying amount? Carrying amount is equal to original cost minus accumulated depreciation minus accumulated impairment loss, right? Accumulated impairment loss. For example, the original cost is 1 lakh, right? Life is 10 years, right? And impairment loss is rupees 5,000, is rupees 5k, right? 5,000. So what is the carrying amount at the end of the first year? What is the carrying amount at the end of first year? Carrying amount at end of first year. What is the carrying amount, guys? 1 lakh minus 10,000 minus 5,000. It is 85,000. 85k is the carrying, right? 85k is the carrying amount. So this is the formula for carrying amount in the cost model. So impairment is there, so you have to check the impairment testing. You have to do the impairment testing, right? So if impairment is there, if the value is decreasing, you have to take the decrease. But if the value is increasing, you are not going to increase the value. Why? Because you are taking the original cost. Okay, you are not changing the original cost, right? So there are two models, cost model and revaluation model, right? Whatever model the company will pick, whatever model the company will apply, these models have to be applied on a consistent basis, right? What is revaluation model? It is fair value model, where the entity has to do the fair valuation. Entity has to do the fair valuation of the asset, right? Entity has to do the fair valuation of the asset. Clear? So what is meant by revaluation model? It is fair value model, right? Sir, if it is fair value model, then of course the entity is required to do the fair valuation on a consistent basis. So first of all, what is the definition of carrying amount in this case? So carrying amount will be equal to revalued amount minus subsequent debt minus subsequent impairment losses. What does it mean? It means that, for example, in this case, the carrying amount will be revalued amount. Okay. For example, the asset was purchased 5 years ago for rupees 1 lakh, and after 3 years, the asset got revalued on 2 lakh rupees. 5 years ago, it was 1 lakh. So 3 years after, it was revalued at 2 lakh rupees. So what is my revalued amount? 2 lakh rupees. And subsequent depreciation, prospectively, the subsequent depreciation will be on 2 lakh rupees, right? So once the asset got revalued, the revalued amount will replace the original cost, right? So in this case, what is the formula for calculating carrying value? Is equal to revalued amount minus subsequent accumulated depreciation minus subsequent impairment losses, right? Sir, if there is a revaluation model, I mean to say fair value model, in that case, whether this revaluation model has to be, this fair value has to be calculated at every reporting year, and answer is no. This revaluation is a cost compulsive exercise. You have to engage the valuer as well, right? So standard says that once you have opted for a revaluation model, you have to do the revaluation. At sufficient intervals, right? At sufficient intervals, if no major volatility is there. So revaluation at sufficient intervals, if no major volatility is there, right? Say 3 to 5 years, okay, 3 to 5 years. But if major volatility is there, then every reporting date. So every year, right? Every year. For example, I still remember in 2012, I was searching a property, right? So I was searching a property near Anand Vihar. So it is the border of Delhi and UP, right? So I still remember at that point of time, the price was changing every day. For example, today, if I'll ask for the price of a 3-bedroom, for example, it was 50 lakh rupees. So just if I'll visit after 5 days, so probably the price becomes 52 lakh rupees, right? If I'll visit after 1 month, the price will probably become 55 lakh rupees, right? So there was huge volatility in the prices. The price was changing extremely. So in that case, there was a huge volatility. If there is a huge volatility in the value, if there is a huge volatility, major volatility is there, in that case, standard says that if you are opted for revaluation model, you have to do the revaluation on the sufficient regularity, or let's say at every reporting date. Okay. If there is no major volatility, then you have to do the revaluation on sufficient regularity, on sufficient intervals. For example, 3 to 5 years, right? But if I ask about the today's price, so today the price is not, the major volatility is not there. For example, if 6 months before you have asked for a price of a property, it was 50 lakh rupees. If you will go today, so probably it was 52 lakh rupees. So there is no major volatility. There is hardly 5-6% of price difference is there, right? So if major volatility is not there, you can go for doing this valuation exercise in the 3 to 5 years. But if major volatility is there, you have to go and you have to repeat this valuation exercise at every reporting date, right? I hope it is clear. I hope it is clear to everyone, friends. Is it clear? Sorry. Okay. Sir, now tell us one thing. This cost model or revaluation model. Can the entity wants to apply this cost model on some item and revaluation model on some item? Can entity do that? So standard says that the entity has to apply this model, has to apply cost oblique revaluation model consistently on a class of assets. A class of assets, right? The company has to apply cost of revaluation model consistently on a class of asset. What is meant by class of assets? So class of assets means the nature and purpose of the asset is same. The nature and purpose of the asset is same. For example, a car, Swift car, Toyota car, Tata car, the car is car. The nature and purpose is same. The nature of the car is same, and the purpose of the car is just to carry the passengers from one place to another, right? So the nature and purpose is same. So what could be the class of the asset? Class of the asset means those asset, grouping of those assets where the nature and purpose of the asset is same, right? So what could be the class of assets? What could be the example of class of assets? The example of the class of assets is, for example, office building, right? Office building, factory building. Factory building nature and purpose is different from the office building. Okay, building. Vehicles, machinery, aircraft, sheep. Okay, furniture and fixtures, furniture and fixture, office equipment, furniture and fixture, office equipment. So what are these? These are the class of assets, right? These are the class of assets. Land. These are the example of class of assets, right? Sir, example, I have 5 office building, right? I have 5 building. Okay. One is in Delhi, Mumbai, Jammu, Kanpur, Ludhiana. Okay. For Delhi building, the value is increased. For Mumbai, the value is increased, right? For Jammu, the value is decreased. Okay. So for these 3 buildings, the value is decreased. So I am just thinking that I should apply revaluation model because my balance sheet will become healthy. I should apply revaluation model for this building. Mumbai building, I need to apply revaluation model for Mumbai building. And for Jammu, Kanpur and Ludhiana, I should continue with the cost model because the value has been decreased. So am I allowed to do that? Am I allowed to do that, guys? Am I allowed to do that? Please tell me. Out of this 5 office building, so these are the 5 office building. These are the same class of asset. And I want to do the revaluation of the first 2 building. Okay. And I don't want to do the revaluation of the last 3 buildings. So am I allowed to do that, guys? What is your view? What is your view? What is your view, friends? Right, Megha? I'm not allowed to do that because whatever model I have to apply consistently with the entire class of assets, right? With the entire class of assets, right? So be it a cost model or be it a revaluation model, I have to apply it consistently. I have to apply entirely. Okay. It is not allowed. It is not allowed. Okay. Is it clear? Is it clear, friends? It is not allowed, Mahendra. So whatever model you will apply consistently to that particular class of assets. Okay. So it is not allowed. It is not allowed. It is wrong. Okay. It is wrong. So entity has to apply. So either cost model or revaluation model needs to be applied. Okay. Consistently consistently for all the asset in the same class. Okay, for all the asset in the same class. Clear? Is it clear? Second example, office building and factory building, right? Factory building. Office building and factory building. The company wants to apply revaluation model in office building, revaluation model in office building, and cost model in factory building. Is it allowed? And cost model on the factory building. Is it allowed? Tell me. So this was my example 1. Okay. And this is my example 2. Guys, is it allowed? So this company wants to apply on first class of asset, the company wants to apply revaluation model. On the second class of asset, the company wants to apply cost model. Is it allowed? Okay. So Utkarsh is saying yes, it is allowed. Yes, it is allowed. Okay. So the company can use either cost model or revaluation model for different class of assets, right? But it has to be applied consistently, right? It has to be applied consistently. Okay. So yes, it is allowed. Okay. It is allowed, right? So friends, we have discussed that the cost model and revaluation model. And now let's move to the PowerPoint presentation, and then we'll again come back to my Excel file and we'll discuss more on this. So measurement subsequent to initial recognition, the company can choose either cost model or revaluation model as its accounting policy. Accounting policy should be applied to the whole of a class of property, plant and equipment, and not merely to individual asset within a class. Like we have discussed that if there are 5 assets in the same class, so same model needs to apply to all the 5 assets, right? Coming to the cost model, what is cost model? So it is the carrying value is equal to cost minus debt minus accumulated impairment losses, right? So we have discussed that. Coming to the revaluation model, so after initial recognition, PPE to be carried at revalued amount being its fair value at the revaluation date, right? And what is the value? What is the calculation of carrying amount? Formula of carrying amount? A revalued amount, because when you do the revaluation, the fair value will replace the original cost, right? For example, 6 years back, I purchased a car for 5 lakh rupees. Or let's say a building would be the appropriate example. 6 years back, I purchased a building for 10 lakh rupees. Now the value of the building is 50 lakh rupees. So 10 will be replaced by 50 lakh rupees. Now the new value is 50 lakh rupees. And subsequently, whatever depreciation I'll recognize, so that will be deducted. If subsequently some impairment will be there, that will be deducted for arriving at a carrying amount. When I say carrying amount is an amount at which the asset has to be carried in the balance sheet, right? If a single item of PP is revalued, then the entire class of PP to which that item belongs should be revalued, right? What is meant by class of asset? A grouping of asset of a similar nature and used in an entity's operations. I have given you the examples. I have given you a lot of examples, right? Yeah. Revaluation model. So valuation need not to be performed every year or every reporting period. As I have told you, this is a cost compulsive exercise. So this valuation need not to be performed every year. Okay. This need not to be performed every year. It has to be performed at sufficient regularity. It has to be performed at sufficient regularity. Okay. So valuation has to be performed at sufficient regularity so that the carrying amount does not differ materially from the fair value. As I have told you that it has to be at sufficient regularity. If the major volatility is there, then the company has to do the frequent revaluation, right? for example, every year. If major volatility is not there, so it has to be in the frequency of 3 to 5 years. So what is the idea? If you're opting for revaluation model, the carrying amount should not be materially different than the fair value, right? So this is the idea. So if the fair value is changing rapidly, so you have to do more frequent revaluation. If the fair value is not changing substantially on a regular basis, then 3 to 5 year revaluation is more than sufficient. Okay. So, sir, how can we say that it is substantial or it is not substantial? How can we say that? Right. So the company can make a policy. For example, if let's say if there is a market scenario which is changing, or let's say if the property prices are increasing more than 10%, because in an economy or in a country or an economy, there is a wholesale price index, there is a consumer price index, there are a lot of indices, right? So the company may make a policy that if the inflation rate is more than 8%, or if let's say this price index is varying from more than 10%, in that case the company will do the revaluation on a yearly basis. Otherwise the company will continue with the last revaluation. So the management may make a policy if they are opting for revaluation, right? Good. Now question arises, sir, when you will do the fair valuation, there would be some gains and losses, right? When you do the fair valuation, there would be some gains and losses. So how to treat with them? Understood? So how to treat with them? So let me share my Excel file again. Sorry. I hope my Excel file is visible, guys. Revaluation gain and losses. Revaluation gains and losses, right? So friends, coming to revaluation gains and losses, for example, let me give you an example. Building was purchased on let's say on 1st April 2021, on 1st April let's say 2019, right? The price was 10 lakh. Subsequently, so the building was purchased for 10 lakh rupees. Subsequently, what happens? The company has opted for revaluation model. So after 1 year, for example, 31st March 20, after 31st March 20, the price has increased to 12 lakh. Okay, the price has increased to 12 lakh rupees. On 31st March 21, the price was decreased to 9 lakh rupees. Okay, the price was decreased to 9 lakh rupees. This is the first scenario. This is the first scenario. Now let me give you the another scenario. Same example. The building was purchased for 10 lakh rupees. On 31st March 20, the price has been decreased to 8 lakh rupees, right? Let's say 7 lakh rupees. And subsequently, on 31st March 21, the price was increased to 11 lakh rupees, right? Now, how to treat? How to treat? And the company has opted for revaluation model, right? So, the company has opted for revaluation model. Now let's do this particular example and solve this particular case study. 31st March 20. What will happen on 31st March 20? Friends, on 31st March 20, the price of the building has been increased by 2 lakh rupees, right? By 2 lakh rupees. So this is case 1 and this is case 2. This is case 1 and this is case 2. So on 31st March 20, what happened? The price has been increased by 2 lakh rupees. So what accounting entry you will pass? Of course, you will do building account debit. So when the price of the asset will increase, what accounting entry you will pass? Building account debit, right? By how much amount? 12 minus 10. Have to debit the building. 12 minus 10, which is 2 lakhs. To credit, what you will credit to bank? You have not paid anything. Then what will be the credited? What will be credited here? To revaluation surplus. To revaluation surplus. And this revaluation surplus will go to OCI. This revaluation surplus will go to other comprehensive income. You must have read Ind AS 1 where the concept of other comprehensive income is there, right? So 2 lakh. Okay. So building account debit, building which is PPE, building which is PPE account debit, okay, to revaluation surplus. What accounting entry you will pass on 31st March 21? Of course, you have to credit revaluation surplus. But what happens after 1 year? After 1 year, the price has been decreased. So on 31st March 20, it was increased by 2 lakh rupees. There was an increase. Okay. So there was an increase. There was an increase of 2 lakh rupees. But here, there is a decrease of 3 lakh rupees. There is a decrease of 3 lakh rupees. So if there is a decrease, of course, what you have to do? You have to credit building to building. If the value of the asset is decreasing, you have to credit the asset. Am I right? To building PP, how much amount? 12 minus 9. 12 minus 9. 3 lakh rupees. You have to credit. But what you will debit? What you will debit here? What you will debit here, guys? Saira, Mahendra, Srinidhi, Vipula, Manikandan, Utkarsh, Megha, Tanushri, Priya. What you will debit? So friends, standard says that if first time there was an increase, that increase will go to revaluation surplus. But subsequently, if there is a decrease, so you have subsequently, if there is a decrease, you have to debit the earlier increase. You have to debit revaluation surplus to the extent of earlier increase. So we have revaluation surplus to the extent of 2 lakh rupees. First of all, it has to be adjusted from the revaluation surplus. This loss, this decrease has to be adjusted from the revaluation surplus. Revaluation surplus OCI debit. Okay, it has to be debited. Debit 2 lakh rupees. So revaluation surplus OCI needs to be debited, right? It has to be debited by 2 lakh rupees. But there is a difference of 1 lakh rupees. The difference of 1 lakh rupees still exists. What to do? So we have nullified my revaluation surplus. It becomes 0. So the differential loss will go to P&L account. Will go to P&L, profit and loss account, right? P&L account debit. It is 1 lakh, right? So this will be the accounting entry. I hope you guys have understood this very clearly. Now coming to the case 2. Let's come to the case 2. Okay. 31st March 20. So coming to 31st March 20. On 1st April 19, the value was 10 lakh rupees. On 31st March 20, the value decreased to 7 lakh rupees, right? So first time there is a decrease. So what accounting entry we need to pass? If there is a decrease, there is no any case of revaluation surplus. If there is a decrease for the first time, it means there is an impairment loss. There is an impairment loss. Okay. So accounting entry will be P&L account debit. P&L account debit, right? So P&L needs to be debited. By how much amount? By 10 minus 7. And of course, since there is a decrease, you need to credit your asset to building PP. Right? So to building PPE. By how much amount? 3 lakh. 31st March 21. What will happen? 31st March 21. So the value has been increased by 4 lakh rupees. See, here the value has been decreased, but subsequently the value has been increased by 4 lakh rupees. So what accounting entry you need to pass? Of course, building account debit, building PPE account debit, right? By how much amount? 11 minus 7, 4 lakhs. Now what needs to be credited, guys? What needs to be credited here? Yeah, what needs to be credited here? Oh, first of all, whatever P&L you have debited, whatever impairment loss you have booked, you have to credit that impairment loss, right? So first of all, we have to credit the P&L to the extent we have debited earlier, right? So how much we have debited earlier? To P&L account, 3 lakh. Whatever we have debited earlier, right? To 3 lakhs. Still, there is a profit of 1 lakh. Still, there is a credit. This credit will go to revaluation surplus. To revaluation surplus OCI. Revaluation surplus OCI, right? Revaluation surplus. I hope it is clear to all of you. Yeah. So friends, if initially there is an increase, it will go to revaluation surplus. Subsequently, there is a decrease. To the extent of increase, to the extent of revaluation surplus, we have to offset the revaluation surplus, right? If there is additional decrease, it will go to P&L account as an impairment loss. Coming to the case 2, of course, if initially there is a decrease, means there is an impairment. And impairment loss standard says that if there is an impairment, it has to go to P&L, right? So like in case 2, initially there was a decrease, so it means there was impairment and it has been recorded as an impairment, right? It has been recorded in the P&L account. Subsequently, there is an increase. It means this impairment needs to be reversed, right? So like impairment reversal concept is there in impairment standard. So to the extent of impairment we have recorded earlier, we have reversed that impairment. And still, if we have some additional amount, additional increase, so that additional increase will go to the revaluation surplus, right? So this is the way how we need to recognize this revaluation gains and losses, right? I hope it is clear to everyone. This is the concept which is given in the standard. I hope it is clear to everyone. Yeah. Sir, how this revaluation, for example, if there is a revaluation surplus, okay, if there is a revaluation surplus which is left and the asset has been sold out, so how this revaluation surplus has to be used? Okay, so standard says that if the revaluation surplus is there, if the revaluation surplus is there and the asset has been sold out, so this revaluation surplus has to go to the retained earnings, right? So it means the revaluation surplus, which is a reserve, will move to retained earnings. So this non-distributable reserve will become a distributable reserve, right? So this will be a reserve to reserve entry, right? So when the asset is disposed of, whatever revaluation surplus will be there, it will transfer to retained earnings. Okay, sir, if for example I have done the revaluation and there is an increase in the value by 10 lakh rupees, if there is an increase in the value by 10 lakh rupees, okay, so utilization of the revaluation surplus, right? utilization of revaluation surplus. There could be two utilization of revaluation surplus. One, at the time of disposal of asset. Disposal of asset. Disposal oblique derecognition. So at the time of disposal of asset, right? At the time of disposal of asset, the balance in revaluation surplus will transfer to retained earnings, right? The balance in revaluation surplus will transfer to retained earnings, right? What is the accounting entry? The accounting entry will be revaluation surplus account debit, revaluation surplus account debit, whatever is in the OCI account debit to retained earnings account, The revaluation surplus is non-distributable reserve. It become a distributable reserve. This is the accounting. Now the second utilization could be at the time of during the life cycle of an asset, right? For example, the original cost of asset was 10 lakh, right? And life was 10 years. Subsequently, the asset got revalued to 20 lakhs. Okay. Subsequently, the asset got revalued to 20 lakhs. Right. The original depreciation was 1 lakh, and the revised depreciation due to revaluation become 2 lakhs, right? So prior to revaluation, it was so this is an example. So prior to revaluation, this was 1 lakh rupees, and post revaluation this becomes 2 lakh rupees, right? So during the life cycle of the asset, how this revaluation surplus will be transferred, the revaluation surplus will be utilized. So standard says that to the extent of every year revaluation surplus will be transferred to retained earning, for additional depreciation. What is meant by additional depreciation? Additional depreciation means depreciation on revalued amount minus depreciation on original amount, right? Original amount. So in this example, what is my depreciation on original amount? It was 1 lakh. What is my depreciation on revalued amount? It is 2 lakh. So every year the accounting entry will be revaluation surplus account debit, to retained earnings. Okay. So 1 lakh, which is 2 lakh minus 1 lakh, right? 2 lakh minus 1. Is it clear? So every year this 1 lakh will transfer to retained earnings, so that in 10 years this additional 10 lakh rupees of revaluation surplus will become 0, right? So the revaluation surplus can be utilized at the end of the disposal of the asset. You have to do that, and even it can be utilized during the life cycle of the asset, right? So at the time of disposal, it is mandatory treatment, because if the asset has been disposed of, there is no point of keeping the revaluation surplus. This revaluation surplus will transfer to retained earnings. But if the entity wants to apportion every year this revaluation surplus to the retained earning, it can do so, right? Yeah. Any doubt, any query so far? Friends, any doubt or any query so far? Okay. Thanks for the confirmation. Good that you guys are able to understand that this concept. So friends, in the revaluation gains and losses, we have already discussed, if first time there is an increase, so it will go to revaluation surplus OCI. And subsequently, again, there is an increase, again, it will go to revaluation surplus OCI. But first time it was increase and the second time it is decrease. So first you need to adjust the revaluation surplus, and if still there is an excess loss, it will go to P&L. If first time there is a decrease, it will go to the P&L. If subsequently there is a decrease, again it will go to P&L. But first time there is a decrease and subsequently there is an increase. So first you need to reverse the P&L debit. I mean to say, whatever you have debited in the P&L, you have to credit that. So first charge to P&L to the extent of earlier debit. Then whatever remains, you have to transfer to revaluation surplus, right? So transfer from revaluation surplus to retained earnings are made in the following circumstances and are not made through profit or loss. I have told you it's a reserve to reserve entry. It is not a P&L entry, right? So when the asset is derecognized, revaluation account debit to retained earnings. And when the asset is used, so difference between depreciation based on the revalued carrying amount and the asset original cost. So the additional depreciation, to the extent of additional depreciation, the revaluation surplus will transfer to retained earning during the life period of the asset, right? So friends, let's have a 10 minutes break. Okay. So it's 8:17 now. So we'll have a 10 minutes break, and after that we will continue the session. Yeah, so friends, let me see if there is any query, otherwise I'll move on. Yeah, so let's do this case study on this revaluation surplus adjustments. ABC Dynamics Limited has purchased two buildings, A and B. There are two buildings, A and B, for rupees 10 lakhs and 15 lakh respectively as on 1st April 2013. Right. So there are two buildings, A and B, 10 lakh and 15 lakh, right, on 1st April 2013. The company is using these buildings to running its office and maintaining its godown. The company is using revaluation model for subsequent recognition of its all classes of building, right? The fair value of the building as at following dates. So first of all, building A was purchased on 1st April 2013 on rupees 10 lakh, and building B was purchased for 15 lakhs, right? So as on 31st March 2014, that is after 1 year, this 10 lakh building has become 14 lakh. So there is an increase, in the value. So what will be the accounting entry? What will be the accounting entry? There is increase in the value of the building A. So building A account debit to revaluation surplus account 14 minus 10, 4 lakh rupees you have to record as a revaluation surplus. As on 31st March 15, so this value has gone down by 5 lakh rupees. So in the first instance on 31st March 14, you have recognized a revaluation surplus of rupees 4 lakh. Now there is a decrease of 5 lakh rupees. So to the extent of revaluation surplus of 4 lakh rupees, you have to adjust revaluation surplus first. So 4 lakh rupees revaluation surplus will be debited. Building 5 lakh rupees will be credited, and the differential will go to P&L, profit and loss account, right? Profit and loss account. Clear? On 31st March 16, this 9 become 11. This 9 become 11, right? On 31st March 16. So again, there is a increase in the revaluation surplus. So see, first of all, there was an increase of 4 lakh rupees, right? So it goes to revaluation surplus. Then there is a decrease of 5 lakh rupees, increase of 4 lakh, decrease of 5 lakh rupees. So this revaluation surplus becomes 0, and net there was a debit of 1 lakh rupees. Net there was a P&L debit of 1 lakh rupees, right? Subsequently, there is an increase of 2 lakh rupees. So whatever P&L debit is there, that has to be removed, that has to be adjusted. And net there is an increase of 1 lakh rupees. If you compare the cost with the final value, so there is a 1 lakh of upside. So this 1 lakh will go to revaluation surplus, right? On the right side, 15 lakh was the cost. So first year there was a decrease of 1 lakh. So P&L will be debited to building B. Again, there is an increase of 2 lakh. So with the decrease of 1 lakh, the P&L should be adjusted, because earlier you have debited P&L by 1 lakh. So you have to credit this P&L by 1 lakh, and the remaining 1 lakh will go to revaluation surplus. Again, there is a decrease of 3 lakh. So whatever revaluation surplus is there, it has to be adjusted, and remaining amount will go to the P&L. So calculate carrying amount of building A and B and treatment of revaluation gains and losses along with the balances, if any, in revaluation surplus account as on 31st March 14, 15 and 16. So let's see this particular solution of the case study. Building A. What was the carrying value of the building A? What was the purchase price? 10 lakh, right? So on 31st March 14, the price become 14 lakh. So there is a revaluation gain of 4 lakh. So it will go to revaluation reserve, right? Accounting entry will be revaluation building A account debit to revaluation surplus account, right? So at the balance sheet date, the carrying value of building A is 14 lakh. The carrying value of revaluation surplus is 4 lakh, right? And there is no P&L here. So this opening will become 14 and this opening will become 4, right? So on 31st March 15, what is the closing value? It is 9 lakh. The value of the building has been decreased to 9 lakh rupees. So you have to credit building by 5 lakh rupees, right? You have to credit building by 5 lakh rupees. And out of this 5 lakh rupees, first of all, you need to adjust this revaluation surplus, because there is an opening balance of revaluation surplus. You need to adjust that. This revaluation surplus will become 0. and now additional 1 lakh rupees you have to debit the P&L, right? Now, subsequently, you have a debit in P&L by 1 lakh rupees, and the carrying value of the PP is 9 lakh rupees. Subsequently, on 31st March 16, it become 11 lakh rupees. So we have to increase 2 lakh rupees. But first of all, whatever debit is there, we have to credit the P&L, and the remaining amount we have to credit the revaluation surplus, right? So what is the accounting entry? The accounting entry is building A account debit 2 lakh, to P&L 1 lakh, to revaluation surplus 1 lakh. I hope this solution is clear to everyone. Friends, let me know if you guys are finding any challenge or difficulty in understanding this concept. Let me know. So Megha is clear, Utkarsh is clear, Rahul is clear. Okay. Yeah. Like building B. So building B, purchase price was 15 lakh. The closing value is 14 lakh. So there is a revaluation gain or loss of 1 lakh rupees. So this 1 lakh rupees of loss will go to P&L. Accounting entry, P&L account debit to building B, right? Subsequently, this becomes 16 lakh. So there is a gain of 2 lakh rupees. So to the extent of 1 lakh rupees P&L debited we have in the last year, we have to credit the P&L in the current year. So accounting entry will be building B account debit 2 lakh rupees, to P&L 1 lakh rupees, then the remaining will go to revaluation surplus of 1 lakh rupees, right? Subsequently, what is the closing value? It is 13 lakh. The closing value is 13 lakh rupees, right? So subsequently, there is a loss of 3 lakh rupees. So far we have 1 lakh rupees in the revaluation surplus, right? So first of all, we have to adjust the revaluation surplus. Accounting entry, to building B 3 lakh rupees, revaluation surplus debit 1 lakh rupees, P&L debit 2 lakh rupees, right? So what you are required to do, you have to just prepare a revaluation surplus account and the P&L impact and the closing carrying value of the PPE in the tabular form, so that you will be able to understand what is the final balance which is lying in these accounts. What is the final treatment, right? Yeah. Utilization of revaluation surplus we have already discussed, right? So when the asset is derecognized, the entire amount of revaluation surplus will transfer to retained earning. When the asset is being used, revaluation reserve may transfer. It is a choice. The amount of revaluation surplus transfer is equal to depreciation on the revalued amount minus depreciation on the original cost. Okay, so this will go to the retained earnings. So transfer from revaluation surplus to retained earnings are not made through profit or loss account, right? So friends, now coming to the concept of the depreciation, right? So we all have understood the concept of revaluation model, the concept of cost model, how to calculate the carrying value, what is the treatment of revaluation surplus. If first time it is an increase, it will go to revaluation surplus in OCI. If subsequently there is an increase, again it will go to revaluation surplus in OCI. If subsequently there is a decrease, so whatever amount is there in revaluation surplus, first of all it has to be adjusted. After that, you have to take it to the P&L. If initially it was a decrease, of course it is like an impairment loss, and impairment loss has to be recognized in profit and loss account. But subsequently, if there is an increase, so it has to be treated like reversal of impairment loss, and whatever you have debited in the P&L, whatever decrease you have accounted for, so you have to reverse, you have to increase to that extent, right? You have to increase to that extent, right? So now coming to the next concept of depreciation. So friends, earlier there was two standard in accounting standard, AS10 and AS6, and AS6 was talking about depreciation only. But nowadays there is only one standard, which is AS10, and which takes care of depreciation part as well. So likewise, in Ind AS 16, Ind AS 16 is also taking care of depreciation part. Okay, so what is meant by depreciation and what is meant by impairment? So friends, what is the difference between depreciation and impairment? Technically speaking, depreciation is something which is identifiable. Depreciation is something which is systematic, right? But impairment is something which is like one-off. For example, I have purchased a car. The value of the car is 10 lakh rupees and life of the car is 10 years. So what is my depreciation? Assuming the scrap value is 0, my depreciation will be 1 lakh rupees, right? But but somehow the car has met with an accident. After 2 years, the car has met with an accident. The moment the car has met with an accident, there will be an impairment of the car, okay? And the market value of the car has gone down by 3 lakh rupees, for example. So it means impairment is one of situation, right? Impairment is not a systematic situation, it is one of situation. You cannot predict the impairment, right? So depreciation is something which is systematic over the useful life. What is depreciation? So depreciation is a depreciable amount of an asset which has to be allocated on a systematic basis over the useful life. Like in my example, the value was 10 lakh rupees and the life was 10 years. So this 10 lakh is the depreciable amount and it has to be allocated on a systematic basis over the useful life of 10 years and it is coming out at 1 lakh rupees. Right. So depreciation charges should be recognized as an expense unless they are included in the carrying amount of another asset, right? So depreciation goes to P&L, but if there is a machinery and that machinery has been used in the construction of the factory, for example, right? So if a machine has been used in the construction of a qualifying asset, construction of an asset, then the depreciation on such machinery is required to be capitalized, required to be added to the cost of the asset, right? Otherwise it will go to the P&L. Coming to the component approach, so friends, we have discussed that in the component approach, what is the component approach? If the significant component of the asset have a different useful life. Sir, what is the significant component? For example, we have discussed major replacement, major overhauls, major inspection, right? So significant means the company may make a policy. So any item which is beyond 10% of the entire cost of the asset may be significant. So significant is not defined in the standard, but generally in practically, the company may form a policy that if a component is having a value of 10% or more or 20% of the, if the component is having a value of 10% or 20% of the entire asset, it will be considered as a significant, right? So standard says that if there are significant component which is having a different useful life, so it has to be depreciated separately, right? So that it will give you accurate depreciation. For example, in my aircraft example, there was an inspection cost of 5 lakh rupees, right? And the inspection has to be done at the end of every 5 years. And there was aircraft for let's say aircraft for 90 lakhs rupees, right? And the life was 20 years, right? So this aircraft of 90 lakh rupees has to be depreciated over 20 years period. This inspection cost of 5 lakh rupees has to be depreciated over 5-year period, so that it will reflect a true picture, right? Because after 5 years, this inspection cost will become 0, right? And a new inspection cost will come. So it means the initial inspection cost will give you a utility, will give you a future economic benefit, okay, to the extent of 5 years only, right? So what is depreciation? Depreciation is something which has to be allocated on a systematic basis over the useful life of the depreciable asset. And depreciation shows the consumption pattern of the asset. Depreciation shows the future economic benefit pattern of the asset, okay? So depreciation has to be charged over the period of future economic benefits, right? Right, friends? So this is again a concept of significant component. If there are significant component, it has to be capitalized and depreciated separately over their useful life. Depreciation, sir, whether depreciation has to be charged from available for use or from put to use. The put to use concept is an income tax concept. Please mind my word. Depreciation has to be started when it is available for use. For example, I have installed my machinery in the factory on 1st January 2020, right? While I was supposed to use that machinery, the COVID came and the national lockdown was there. The national lockdown was there. And due to the national lockdown, I could not be able to use that machinery for 6 months. And I started first time I have started using that machine on 1st July 2020. So my depreciation will start from 1st July 2020 or 1st January 2020. My depreciation will start from 1st January 2020. So friends, please remember, in accounting standard and in Ind AS, depreciation of an asset will start when it is available for use. Okay, when it is available for use. And what is meant by available for use? When it is in the location and condition necessary for it to be capable of operating in the manner intended by the management. So it is in the location, it is in the condition, it can be used immediately. So the only thing is you have not used does not call for that the depreciation will not be charged, right? So depreciation is charged till point residual value is greater than or equal to carrying amount. What does it mean? So depreciation, for example, the cost of the asset is 1 lakh rupees. The residual value is 10,000 rupees. So of course, depreciation has to be charged for 90,000 rupees, right? If there is a residual value, so to the extent of residual value, depreciation is not going to be charged, right? So depreciation has to be charged till point the residual value is greater than or equal to the carrying amount, right? So 1 lakh, 10,000 is the residual value. So I need to charge 90,000 rupees of depreciation. Now this 10,000 of carrying value is equal to the residual value, right? So I will not charge the depreciation. Sir, when should I stop the depreciation? Depreciation will be stopped when the asset is sold out, when the asset is derecognized, asset is disposed of, or the asset is held for sale under Ind AS 105. You will read Ind AS 105. It says that when the asset is classified as held for sale, in that case, depreciation will be stopped from the date when the asset is classified as held for sale. So Vidula, 1st July is not the date from where the depreciation has to be started. 1st July is put to use. Okay, the ready to use, available for use was 1st January. So the concept was when the asset is available for use, and asset was available for use on 1st of January, right? So on, you can say that on 1st July it was put to use. I mean to say actual use was started. Right, Vidula? Depreciation does not stop automatically when the asset is idle. What does it mean? Sir, I was having 5 machinery, right? And due to COVID, the demand has gone down. So I kept 2 machinery in the godown, or let's say I kept 2 machinery. Just I shut down these 2 machinery, I packed those machinery, okay? And I'll use that machinery when the demand gets picked up. So my asset is lying idle. Sir, should I discontinue the depreciation on those machinery? Answer is no. Depreciation does not stop automatically when the asset is idle. Depreciation has to be there, right? Depreciation has to be there. Depreciation method. Now, what are the depreciation method, guys? What are the depreciation method? Can you let me know what are the depreciation method? This is not the new thing. So first of all, what is depreciation? I have told you that the depreciation is the systematic allocation of depreciable amount over the useful life of the asset. And depreciation method, depreciation shows the consumption pattern of the asset, right? Shows the future economic benefit pattern of the asset, right? So depreciation method should reflect the pattern in which the asset's future economic benefit are expected to be consumed by the entity. It's a consumption pattern. It's a future economic benefit pattern. Like I'll take an example. Straight line method. So when straight line method is required to be applicable or is required to be taken into consideration. So straight line method means the asset has to be straight line method means when we are expecting that the future economic benefit, the pattern of future economic benefit is consistent from over the useful life. It means we will have the same pattern of benefits, same consistent benefits over the useful life of the asset. In that case, we have to charge depreciation on straight line basis, right? So when I'm expecting that my machinery will provide same output throughout the period, throughout the useful life, in that case, I will charge the depreciation on a straight line basis. Okay, so my cost and benefit should be consistent from one period to another. If I'm expecting that my machinery will provide higher output in the initial year and it will goes down when the life goes on, right? So straight line method, I'm saying, when I'm saying straight line method, so I am expecting consistent future economic benefit, consistent consumption. When I'm saying WDV, what I'm expecting? I am expecting decreasing pattern of future economic benefit. I am expecting that in the initial year I will have higher future economic benefits. I will have higher output, and subsequently the output goes decline. So in that case, what is the appropriate method of depreciation? WDV is the appropriate method of depreciation, right? WDV is the appropriate method of depreciation. Now the third method, SLM, WDV, we have discussed. The third method is unit of production method. Unit of digit or unit of production method. What is meant by unit of production method? So unit of production method means it is depending on the usage of the asset. For example, you all are must be doing your articleship, and so you're doing auditing, you are going to see a firm. You must have seen the projector. LED projector. So if you go to buy an LED projector and if you ask the vendor, what is the life of this LED projector? He will not say that the life is 5 years. He will not say the life is 10 years. You know what he will say? He will say, sir, life is, let's say, 30,000 lamp hours, 30,000 hours. What does it mean? It means if you use this projector 30,000 hours in a year, so probably it will be so the life of the projector will finish in 1 year. If you will not use this projector for first year, you will use the second year, or let's say in the first year you will use 5,000 hours, in the second year 10,000 hours, in the third year 4,000 hours, right? So whatever period it will be, so whenever you will complete approximate 30,000 hours, the life will come to an end, right? So the crux of the story is, when I'm talking about this kind of asset, LED bulb, okay, LED projectors, so these kind of assets, life is expressed in terms of usage, 30,000 lamp hours. What does it mean? It means it is not talking about years, it is not talking about months, it is not talking about time, it is talking about usage, right? So unit of production method means usage based method. If an asset has to be used, depreciation is required to be charged. If an asset will have a lower usage, depreciation will be lower. In a period when the usage is higher, depreciation will be higher. So in the COVID period, the companies which have used this unit of digit or production method, they have not charged any depreciation in the lockdown period where the usage was not there. But the companies which were using SLM WDV method, so they have to continue the depreciation even though asset was lying idle, right? So where the uses are very volatile in those kind of industries, okay, so the depreciation has to be charged on a unit of production method. So friends, if there is significant change in the expected pattern of consumption, method of depreciation is also required to be changed in line with the future benefits. So that is why change in depreciation method is not a change in policy. Change in depreciation method is change in accounting estimate. Please remember, change in depreciation method is change in accounting estimate, guys, right? So when I have to use an SLM, when there is a constant charge, when WDV, when there is a diminishing charge, when sum of units, I mean to say unit of digit, charge based on the expected outputs, right? Change in method is accounted for a change in accounting estimate as per Ind AS, not a change in policy, right? Any doubt here? Sai, Srinidhi, any doubt here? Okay. So friends, let's do this case study of change in depreciation method. An entity acquired an asset 3 years ago at a cost of 5 million, right? So the cost was 50 lakh and 3 years ago. The depreciation method adopted for the asset was 10% reducing balance method. 10% reducing balance method. What does it mean? The cost was 50 lakh rupees. So in the first year, depreciation was how much? In the first year, 5 lakh rupees. 45 is the carrying value. Again, in the second year, the depreciation was 4.5 lakh rupees. The closing value was 40.5. And in the third year, the depreciation was 4.05. And what is the value? 40 minus 4, 36.45 lakhs. 36.45 lakhs. Okay. At the end of year 3. So, okay. At the end of year 3, the entity has estimated, right? So at the end of year 3, the WDV was 40.5 lakh and depreciation was supposed to be charged. At the end of year 3, the entity estimated the remaining useful life of the asset is 8 years and determined to adopt straight line method from that date so as to reflect the revised estimated pattern of recovery of economic benefits, right? So at the end of year 3, the entity estimated that the remaining life is 8 years and we have to shift to SLM method, right? So how to account for this? So guys, if you see, in year 1, what was the depreciation charge? 5 lakh. In the year 2, 4 lakh 50,000. In year 3, 4 lakh 5,000. So what is my carrying value? My carrying value is how much? 36.45 lakhs. And when I divide 36.45 lakhs by 8, 36.45 divided by 8, what is the answer? If I'll divide 36.45 lakhs, what is the answer? Can you tell me the answer? 36.45 divided by 8. Yes, what is the answer? Yeah. So it is 8 for the 32. 4. So approximate 4,55,000, right? 4,55,000. You are right. 4,55,625. Yeah. So what is the prospective depreciation? 455,625. So since this is an accounting estimate, change in estimate, it has to be applied prospectively. It is not applied retrospectively, it is applied prospectively, right? So till this time it was WDV. From year 4 to year 11 it was SLM. What is the working notes? In the first year, the value was 50 lakh, depreciation 5 lakh, closing value 45 WDV. So second year 4.5, WDV 40.5. Third year 40.5, WDV 36.45. Right. So year 3 onwards, method of depreciation has been changed from WDV to straight line method, for which it is assessed that the remaining useful life is 8 years. Hence, revised depreciation would be calculated as follows. Right. So revised depreciation as per straight line method is equal to carrying amount as at end of the third year, which is 36.45 lakh, divided by remaining useful life 8 years. So it is giving you 455,625 per annum, right? Change in estimate of useful life and residual value. First of all, friends, every year end. So at the end of every year, you have to revisit, you have to estimate, you have to revisit your useful life. You have to see whether my useful life is in line with what I have estimated or what I expected earlier, or it is require any change. Okay, you have to see that. And residual value. So for example, you have expected a residual value of let's say 10 rupees, right? So you have to revisit, is it still 10 or it becomes higher or shorter? Okay, it becomes more than 10 rupees or less than 10 rupees. You have to still look at that. So useful life and residual value are to be reviewed at every year end. Okay. If there is any change in useful life or residual value, the same has to be treated as a change in accounting estimate, and accounting will be done prospectively. Like we have seen that if there is change in depreciation method, if there is change in depreciation, if there is change in residual value, it has to be applied prospectively. Okay, not retrospectively. Future annual, what is meant by prospective? Future annual depreciation will be revised basis the new useful life, like we have seen that in this particular case, right? Let's do one more case study on this from Institute Study Material. XYZ Limited purchased an asset on 1st January 2000 for rupees 1 lakh. Okay. and the asset had an estimated useful life of 10 years and residual value was 0. So 1 lakh rupees is the cost, life is 10 years. What is the depreciation? 10,000. The company has charged depreciation using the straight line method at 10,000 per annum, right? On 1st January 2004, that is after 4 years. So 1, 2, 3, 4. Okay. The management of XYZ Limited reviews the estimated life and decide that the asset will probably be useful for a further 4 years, and therefore the total life is revised to 8 years. How should the asset be accounted for in the remaining years? So guys, when the company has purchased this asset, the life was 10 years, right? But after 4 years, how much was the remaining life? It should be 6 years. But the company has estimated the remaining life is not 6 years, it is 4 years only. So first of all, what is the closing value at the end of the 4 years? If the value is 1 lakh rupees and life is 10 years, my depreciation charge is 10,000. So what is the accumulated depreciation for 4 years? Accumulated depreciation for 4 years is 10,000 multiplied by 4, 40,000. What is my carrying value at the end of 4 years? What is my carrying value at the end of 4 years? It is 60,000, right? 1 lakh minus 40,000. Now, what is the remaining life? The remaining life is 4 years. So what is the revised depreciation? What is the revised annual depreciation? Annual depreciation prospectively, it will become 15,000. 60 divided by 4, right? So change in useful life of an asset is change in accounting estimate, which has to be applied prospectively. That is, the depreciation charge will need to be recalculated, right? On 1st January 2004, when the asset's net book value is 60,000, okay, the net book value is 60,000, the company should amend the annual provision for depreciation to charge the unamortized cost over the revised remaining life of 4 years, right? So the WDV or carrying value is 60,000 and we need to depreciate it over a next 4 years period. 60 divided by 4, it comes out at 15,000, right? So for the first 4 years, the depreciation was 10,000 per annum. For the next 4 years, the depreciation was 15,000 per annum, right? I hope it is clear to everyone. Yeah, so coming to the next concept of retirement and disposals. So friends, the carrying amount of an PPA. So friends, we talked about the initial cost. We talked about the recognition. We talked about the subsequent measurement. I mean to say measurement subsequent to the recognition. So we talked about the birth of the PPE. We talked about the life of the PPE. We talked about the depreciation and impairment of the PPE. Now we are talking about the retirement or disposal, the death of the PPE. So we have come to the end of the life cycle of the PPE, right? So when the PPE is required to be derecognized, when it has to be derecognized. So recognition condition, we are aware that if the future economic benefit is probable and cost can be measured reliably, the item has to be recognized as PPE. But when it is required to be derecognized, the PPE, the carrying amount of the PPE shall be derecognized on disposal. When you are actually selling the PPE, sir, I have a car and the carrying value of the car was 2 lakh rupees. I have sold out that car. Of course, I have to make an accounting entry, bank account debit to car account, 2 lakh rupees, right? Right. So when you are actually selling the car, when you are actually derecognizing the car, selling the car, disposing the car, so you have to derecognize the car. Or when no future economic benefit are expected from its use or disposal. For example, you have purchased a machinery from China, right? And the life of the machinery was, let's say, 20 crores rupees. So the cost of the machinery was 20 crores rupees and the life of the machine was, let's say, 20 years. So you're using this machinery since last 10 years and the remaining carrying value is 10 crore rupees, right? So the government has announced that whatever output which was getting produced from that particular machinery has to be banned. Okay. So now you're not allowed to produce the output from that particular machinery. Now the question arises, whether this machine will provide a future economic benefit? Answer is no. the machine will not provide the future economic benefit. The machine will not provide the future economic benefit. Why? Because that was the only output which has been produced from that machinery, and the government has banned that output. So what does it mean? In this case, the future economic benefit which we have enjoyed in the last 10 years, we are not able to enjoy in the next 10 years. So it means future economic benefit is not expected from its use. It means this PPE shall be derecognized as a PPE, right? Understood? Is it clear to everyone? Guys, let me know if you have any doubt, or is it clear to everyone? So friends, the PPE shall be derecognized on disposal, and when no future economic benefit are expected from its use or disposal, right? If there is any amount of gain or loss, for example, the carrying value was 10,000 and the asset has been sold for 15,000. So there is a gain of 5,000. So where this gain will go? Whether it will go to the revenue, answer is no. It will go to the other income, right? So the gain will not be a revenue from operation. It is a other income. So it has to be recognized in profit or loss when the asset is derecognized. And gain shall not be classified as revenue. Revenue is the operating item. You all have already understood the concept of revenue from contract with customer, and we have discussed that. Revenue is something which is ordinary in nature. Revenue is something which has been arises on the sale of goods and services, right? So this is not a revenue, this is a gain, this is other income, right? So it has to be recognized as other income or other expenses. So this was something about retirement and disposals. So guys, I'll just take a 15 seconds pause and let me know if you have any query. Students who are just watching the live session, let me know if you have any query. Otherwise, I'll move on. Yeah, I'm just taking a 15 seconds pause and I'm just waiting for the query. If there's any query, I'll discuss that. Otherwise, I'll move on. Yeah? No? So few of the participants have already replied that yes, sir, it's clear already. Yeah. So guys, let's discuss illustration number 4, the revaluation model for entire class from the Institute Study Material. Venus Limited is a large manufacturing group. Okay. It owns a considerable number of industrial buildings, such as factories and warehouses, office buildings in several capital cities, right? So the company is having a lot of industrial buildings like factory and warehouses. The industrial buildings are located in industrial zones, where the office building are in central business district of the cities, right? So industrial buildings are located in industrial area, and of course the office building is located in the heart of the town, right? So there are industrial building, there are office buildings. So first of all, we need to understand whether the industrial building or office building are same class of asset or it's a different class of asset. So you need, what is meant by class of asset? Class of asset means the nature and purpose of the use, right? So the nature is different for industrial building and office building, and of course the purpose is different. In industrial building, there must be a production, and in office building, there must be administration kind of thing, right? So Venus Limited management wants to apply Ind AS 16 revaluation model to subsequent measurement of the office building, but continue to apply the historical cost model to the industrial building. So this management wants to apply the revaluation model to the office building, but cost model to industrial building. Is this acceptable under Ind AS 16 property, plant and equipment? Tell me what is your answer. So for office building, they want to apply the revaluation model, but for industrial building, they want to apply the cost model. Can they do so? Can they do so? Yes, it is a different class of asset. They can do so. Venus Limited management can apply the revaluation model only to the office buildings. The office building can be clearly distinguished from the industrial buildings in terms of their function, their nature, and their general location, right? And Ind AS 16 permits asset to be revalued on a class by class basis, right? So since these two are different nature of buildings, these two are different class of assets. So that is why for different classes of assets, different model can be applied. So the different feature of the building enable them to be classified as different class of PPE. The different measurement model can therefore be applied to these classes for subsequent measurement. All properties within the class of office building has to be carried at revalued amount, and all the buildings within the category of industrial building has to be carried at cost amount, right? So within the class, every asset has to follow the same model, which this entire class is following, right? So that is there. Let me know if any query is there. Otherwise, I'll move on. So Mahendra is asking, sir, impairment loss. So what is impairment loss? Impairment loss, you will read this session separately on impairment. There is a separate standard on impairment of assets in Ind AS 36. But I have told you what is impairment. Impairment is something like when the carrying value is higher than the recoverable value. The market value has gone down, right? So in that case, there will be an impairment. For example, I have purchased a car. The cost of the car is 10 lakh rupees. The life is 10 years. So what is my depreciation? 1 lakh rupees every year. Okay, after 2 years, my expected carrying value was 8 lakh rupees. But suddenly this car was a diesel car. And the government has announced that diesel car will be banned in India in the next 1 year, right? So market value will go down suddenly. So due to this announcement, the efficiency of the car will not go down. The efficiency, the quality, the feature, the productivity of the car will not go down. But of course, the market value will go down. So what is this? This is an impairment. So technically speaking, impairment is over and above of depreciation, right? It is over and above of depreciation. Yeah. So friends, let me move to my presentation once again. Yeah, any other query, guys? You're right, Srinidhi. Venus Limited can apply these two different models. Yeah. Is it clear? So let me show you the one case study on utilization of revaluation surplus. So let me share this case study. Illustration number 5, utilization of revaluation surplus, right? An item of PPE was purchased for 9 lakh rupees on 1st April 2001. It is estimated to have a useful life of 10 years and is depreciated on a straight line basis. So PPE was purchased for 9 lakh rupees and useful life of 10 years and depreciated on a straight line basis. So 9 lakh divided by 10, 90,000 is the depreciation. On 1st April 2003, the asset is revalued. So after 2 years, 2002, 2003, the asset is revalued to 9,60,000 rupees, right? So instead of 9 lakh, the value becomes 960. The useful life remains unchanged as 10 years. Useful life remains unchanged as 10 years. Ignore impact of deferred taxes. So the life becomes 10 years only, but after 2 years, there is a revaluation, and the revaluation has made it to 9,60,000. You are required to show the necessary treatment as per Ind AS 16 to calculate depreciation and revaluation surplus for 2003-2004, right? So guys, first of all, what was the initial depreciation? 9 lakh divided by 10, 90,000, right? Subsequently, the value become 9,60,000, right? So after 2 years, value become 9,60,000. So my 9,60,000 become my gross block. So I have to depreciate this 960 over a period of next 8 years. So 960 divided by 8, what will be my revised depreciation? My revised depreciation will be 1,20,000. My revised depreciation will be 1,20,000. What was my existing depreciation? My existing depreciation was 90,000. So what is my additional depreciation? My additional depreciation is 30,000, right? This is my additional depreciation is my 30,000, right? So friends, this is the treatment of how this, revaluation, how this depreciation will be calculated basis the revaluation amount, right? Now, this 30,000 has gone to the this 30,000 is the additional depreciation, and 9 versus 9,60,000. 60,000 has moved to revaluation surplus. right? Now, what will be the accounting entry? In the profit or loss for 2003-2004, a depreciation expense of 1,20,000 will be charged. A reserve transfer, which will be shown in the statement of changes in equity, may be undertaken as follows. So whatever additional depreciation has been charged, to that extent, revaluation surplus can be transferred to the retained earnings, right? Revaluation surplus can be transferred to the retained earnings, right? And what is the balance arising on revaluation? 9,60,000 minus 7,20,000. And how this 7,20,000 came? You remember? The value was 9 lakh. The original value was 9 lakh, right? 2-year depreciation was how much? 90,000 per annum. So 9 lakh minus 90 minus 90. 9 lakh minus 180 comes out at 720, right? So 960 minus 720, it comes out at 2,40,000. 2,40,000. So my total revaluation surplus is 2,40,000 because the carrying value at the end of 2 years was 720 and the revalued amount was 960. 960 versus 960 versus 720 comes out at 240. So I have 240 in my revaluation surplus. So I have two options. One option, when I will de-recognize this asset, I will transfer the entire revaluation surplus to retained earning. Second choice I have that I can split this 240 into 8 years. And whatever additional depreciation is there, to the extent of additional depreciation, I can transfer my revaluation surplus to retained earning so that every year I will get the distributable amount. I will compensate the higher depreciation due to the higher revaluation. Right? Understood? So that is why in this case, what I have done. So 240 divided by 8, 30,000. And what is the additional depreciation? It is 30,000. So in the proportion of additional depreciation, we can transfer the revaluation surplus to retained earning on a yearly basis, right? I hope it is clear to everyone, guys. I hope it is clear to everyone. Yeah. Clear? Is it clear, friends? Let me know if you have any query. Let me know if you have any query. Otherwise, I'll move on. Yeah. So yes, there is one query. Srinidhi is asking, sir, compensation for impairment is not clear. Srinidhi, let me tell you. What is meant by compensation for impairment? For example, there is an impairment, right? For example, I have a car, right? The cost of the car is 10 lakh rupees. Life is 10 years. After 2 years, what is my carrying value? 8 lakh rupees. 10 minus 1 depreciation, 8 lakh rupees. So due to the, let's say, due to the bad announcement, for example, due to the bad news of that particular brand, for example, you must have heard about Daewoo Motors. Have you heard about Daewoo Motors? DAEWOO, like you must have heard about the Matiz car. Matiz, right? So Matiz belongs to the Daewoo Motors, right? And for example, I purchased Matiz car, right? So after 2 years, my expected value should be 8 lakh rupees, but there was an announcement that this Daewoo Motors is going to be bankrupt, or let's say Daewoo Motors is just closing their operations in India. Due to that, of course, the value of the car will go down. Of course, the value of the car will go down, right? And there will be an impairment. So I have a contract with Daewoo Motors, and they have told me that whenever there is an impairment, whenever there is a loss of value, we will compensate you. We will compensate you, right? So first of all, I have to recognize this impairment loss in my books of accounts when there is a loss of value, right? But when there is a contract, I mean to say, I will get a compensation for this impairment. So I will recognize this compensation for impairment when it is certain that it will be receivable, right? For example, I will receive 2 lakh rupees the impairment loss, and I'll receive 1,60,000. So what will be my net impairment? My net impairment will be 40,000 rupees, right? So whatever I'll receive, it has to go to the P&L, right? So when the compensation become receivable, it will go to the P&L. The life of the asset will not be increased. Please mind my word. The value of the asset will not be increased. The amount has to go to the P&L. So once you have charged the impairment loss, what accounting entry you have passed? P&L account debit with impairment to car account, 2 lakh rupees. Now you will get the money, okay, from the Devu Motors. So for example, 1,60,000. So bank account debit 1,60,000 to P&L account 1,60,000. Net impact will go to the P&L for 40,000. Sir, what happens if I'll receive 2,50,000? Bank account debit 2,50,000, right? To P&L 2,50,000. So this 50,000 credit, this 50,000 extra benefit will pass on to the P&L. So 2 lakh you have debited in P&L, 2,50,000 you will credit in P&L. So you will have 50,000 in the P&L. So whenever there is a compensation for impairment, whenever there is a compensation for impairment for asset lost, asset given up, asset impaired. So whenever this compensation becomes receivable, when it is virtually certain that the compensation will be receivable, so it has to be taken into the profit and loss account. You are not required to add to the value of the asset, right? The value of the asset will not be added. It has to go to the P&L. Is it clear? Because actually value of the asset is not going up. The value of the asset is 720 only. Let's say it was 8 lakh and now it becomes 6 lakh. It is 6 lakh only. The only thing is whatever compensation, whatever impairment you are charging to the P&L and you are getting a compensation, you have to credit your P&L to that extent, right? Is it clear? Is it clear? Is it clear, friends? Yeah. So let me move on to the multiple choice questions quickly, so that I can check whether you are able to understand the concept or not. A change in depreciation method is a change in policy, change in estimate, change in accounting method, or change in accounting standard. What is the right choice? What is the right answer? If you're changing a depreciation method, of course, it is showing the change in the consumption pattern or change in the future economic benefit pattern, right? So from SLM to WDV, WDV to unit of production method, or whatever it may be. And we have done 2-3 case study of prospective implication. And when it has to be applied prospectively, when there is a change in estimate. So B is the right answer. And most of the students have given the right answer. So answer is B. Para 61 of India 16. Sir, do we require to quote the para number? No. In the examination, don't quote the para number, right? It is not required. Change in depreciation method shall be accounted for as a change in accounting estimate in accordance with Ind AS 8, right? When an asset is sold or disposed of, where is the gain or loss recognized? Asset disposal account, profit and loss, revaluation reserve, or depreciation? What is the right answer? What is the right answer? The right answer is profit and loss account. It is not, when the asset is sold or disposed of, the gain is not recognized in asset disposal. It is not recognized in revaluation reserve. It is not recognized in depreciation. It has to be recognized in profit or loss, right? Answer is B. So para 68 says that the gain or loss arising from the derecognition of an item of PPE shall be included in the profit or loss, right? Under Ind AS 16, how often should the useful life of an asset be reviewed? Have I told you that the useful life of the asset and the depreciation method has to be reviewed at least at each financial year end, every 6 months, at management discretion, or never? What is the right answer? It has to be at least at each financial year end. Yes. So most of the students are right. Answer is A. Para 61 says that the depreciation method applies to an asset and useful life shall be reviewed at least at each financial year end. How should an item of PPE be initially recognized in the financial statements? Measure at market value, cost, measure at NRV, measure at fair value. What is the right answer? Initially measured at what value? Initially measured at what value? Guys, reply quickly. Question number 4. Remember, the PPE has to be initially measured at cost. Cost means purchase price plus import duties plus non-refundable taxes minus trade discount and rebates plus directly attributable cost plus site restoration cost, right? So it has to be measured at cost. Para 15 says that an item of PPE that qualifies for recognition as an asset shall be measured at cost. If one large asset has a number of individual components with different useful life, how should this be depreciated? If one large asset has a number of individual components with different useful life, how should this be depreciated? Whether I treat it as one asset, break down into different components, expense it all, or treat it as one asset but disclose in the notes to the financial statement. What is the right answer? Of course, if the individual component is having a different useful life, you have to break down into the different components, right? We have discussed this thing. It has to be broken down into the different components, right? Under Ind AS 16, which two subsequent accounting treatments are allowed subsequently to initial recognition? Tell me. Measurement after initial recognition, subsequent initial recognition. Cost model and present value model, cost model and revaluation model, fair value model and revaluation model, fair value model and cost model. Which is the right answer? Of course, cost model and revaluation model. Para 29 says that an entity shall choose either the cost model or the revaluation model as its accounting policy and shall apply that policy to an entire class of property, plant, and equipment. Question number 7. Question number 7. What is the answer of question number 7? When it is dash, that future economic benefit associated with an asset will flow to the entity and the cost can be dash measured, it should be recognized as an asset. What is the right answer? Possible, reasonably, possible, reliably, probable, reliably, probable, reasonably. What is the right answer? When it is possible or probable? Possible or probable? What is the right answer? When it is probable that future economic benefit associated with an asset will flow to the entity and the cost can be reasonably or reliably. Cost can be reliably measured. Reliably. So right answer is C. Right? So the cost of an item of PP shall be recognized as an asset if and only if the future economic benefit is probable and cost can be measured reliably. Right? Clear? Most of you have given the right answer. Vidula, it is not A. It is not possible reasonably. It is probable and reliably. Right? Which of the following is not an asset that falls under the scope of Ind AS 16? Tangible asset. Tell me whether tangible asset falls under the scope of Ind AS 16 or does not falls under the scope of Ind AS 16. Tangible asset falls under the scope of Ind AS 16. Asset held for the production or supply of goods and services. It is fall under the scope of Ind AS 16. Asset held for sale in the normal course of business. Guys, is it PP? Asset expected to be used for more than one period. Of course, these three falls under the scope of Ind AS 16. What is this? This is inventory. Inventory. Asset held for sale in the normal course of business. This is inventory. So C is the right answer. Inventory does not fall under the scope of Ind AS 16. Right. Question number 9. When the revaluation model is used for PPE, the gain or loss should be included in income for the period. The gain from revaluation on the income statement, a revaluation surplus account in OCI, an extraordinary gain or loss on the income statement. Tell me, when you are opting for revaluation model, there is a gain, right? So where that gain will go? Where the revaluation surplus will go? It goes to revaluation surplus. Where? It goes to OCI, right? It goes to OCI. What is the right answer? It goes to other comprehensive income. It goes to revaluation surplus in other comprehensive income. Okay. Question number 10. Which of these is an allowable cost of an asset under Ind AS 16? Okay. So what is the allowable cost? Which is the directly attributable cost? Professional fees, general overheads, initial operating losses, administrative expenses. Tell me which is allowable. Whether general and administration and overhead allowed. General administrative overheads are not allowed to be capitalized. Initial operating losses are not allowed to be capitalized. Administration expenses are not allowed to be capitalized. So what can be capitalized? Professional fees can be capitalized, right? So right answer is A. Para 17F of Ind AS 16 says that professional fees are allowed as a cost of an asset so long as the cost incurred is directly related to the asset, right? Thank you so much, guys. So today we have recapped the first part of the lecture, as well as today we have completed the second part of Ind AS 16. Let me go to the query box. Let me see if there is any query. I'll discuss that. Otherwise, I'll move on. Yeah. Otherwise, I'll conclude the session. Let me look at the query box. So guys, we have time. Then we have the time. Please let me know if you have any query. So Anmol Ahuja is having a query. So good morning, sir. Please reply to my query at the end of today's session so that it would not break the flow of current topic. Sorry to disturb you in between. Another topic. I was following your classes for the topic Ind AS 115. As I'm not confident in that topic, but after your sessions, I could able to understand this Ind AS really well. Thank you, Anmol. I am happy that you have liked the session. In the last live session on 5th March, you told us that 6th session of 115 will be recorded and will be updated soon. But I was not able to find that lecture on YouTube channel. Please tell me from where I can access that session. So Anmol, I'll discuss with Board of Studies, guys, and I'll ensure that this should be, updated and uploaded if it has not been uploaded, right? So just wait for a day or just wait for another day. Probably if it has not been uploaded, it will be uploaded. Vidula is asking, sir, illustration number 5 is not clear. Okay, Vidula. So let me share that illustration number 5 and we can discuss this illustration number 5 once again. Just hold on, Vidula. Let me go to illustration number 5. I hope you are able to see the screen of Institute study material. So Vidula, first of all, illustration number 5. Let me first of all, let me share my Excel file so that you will be able to understand it in a better manner. So I'm talking about illustration number 5. Illustration 5, okay, of study material. What was the original cost? The original cost of the asset was 9 lakh rupees, right? Is it clear? Original cost of the asset was 9 lakh rupees. What was my life? The life was 10 years. After 2 years, what is my WDV after 2 years? What is my WDV after 2 years? WDV after 2 years. So what will be my depreciation? What will be my yearly depreciation? Yearly depreciation. What is my yearly depreciation, Vidula? 9 lakh divided by 10. 90,000 is my yearly depreciation. What is my WDV after 2 years? After 2 years, my WDV will be 9 lakh minus 90,000 into 2, right? My WDV will be 7 lakh 20,000, right? So what is my revalued amount? What is my revalued amount? My revalued amount is 9 lakh 60,000, right? It is 9 lakh 60,000. I hope the data is clear to everyone. 9 lakh 60,000. What is the remaining life? What is the remaining life, guys? 8 years. What is the revised depreciation? What is the revised depreciation going forward? Of course, 960 divided by 8. Prospectively, it will change. Okay. And what is the revaluation surplus? What is the revaluation surplus? What is the accounting entry? The accounting entry will be at the end of 2 years. At the end of 2 years, what is my accounting entry? My accounting entry will be asset account debit. Asset account debit. Asset account debit to to revaluation surplus, right? To revaluation surplus. And what is the value of revaluation surplus, Vidula, in this case? Can you please reply? What is the value of revaluation surplus? Asset account debit, the revised value is 960. The carrying value is 720. My asset will be debited by 240. My revaluation surplus would be credited by 240. Is that clear? Now, what are the utilization of revaluation surplus? There are two utilization of revaluation surplus: at the time of disposal of asset or during the life cycle of the asset. For example, I am utilizing this revaluation surplus during the life cycle of the asset. Okay, utilizing the revaluation surplus, during the lifetime of the asset. Utilizing the revaluation surplus during the lifetime of the asset, right? How much I can utilize every year? So how much I can utilize? How much I can transfer from revaluation surplus to retained earnings in the next 8 years? How much? Tell me. This is equal to revised depreciation minus normal depreciation. So what is my revised depreciation minus normal depreciation? 1,20,000 minus 90,000, right? Minus 90,000. So what accounting entry I need to pass? I need to pass revaluation surplus account debit, revaluation surplus account debit every year, revaluation surplus account debit to retained earnings, right? Every year. And to what amount? To what extent? At which amount? 120 minus 90, which is like 30,000, right? So 120 minus 90, 30,000. 30,000 is your. So this needs to be transferred at the end of every year. So I hope it is clear to you, Vidula, now. I hope it is clear to you guys. Is it clear? I hope it is clear to everyone. Yeah. Vidula, is it clear to you now? Yeah, great. Thank you so much, guys. Thank you so much. I hope you guys have understood this Ind AS 16 property plant and equipment very well. So I have covered a lot of case studies from ICAI study material, and I have covered a lot of examples from my side as well. So this PowerPoint presentation and this Excel file will be uploaded soon by ICAI. So probably today itself. Okay. So thank you so much, guys. Students, stay happy, stay healthy. Thank you so much. Bye-bye. Take care.